If you love dividends and you're hunting for solid Singapore REITs, this one's worth your copy. Today, we're diving into Mapletree Pan-Asia Commercial Trust, or MPACT for short, one of Singapore's biggest Pan-Asian REITs that's now serving up a 5.5% dividend yield. Stay till the end, because I'll show you whether MPACT looks undervalued at $1.46, how future Fed rate cuts could affect its payouts, and how you, as a Singapore income investor, can evaluate it for your portfolio. We'll cover what a REIT really is, in simple English, what MPACT owns and where its properties are, its latest second quarter and half-year 2025 financial results, whether it's undervalued or overvalued, its dividend yield and payout sustainability, and the future prospects and risks ahead. If you find this useful, give this video a like so more Singaporeans can learn about dividend investing. And subscribe to Wealth for You for more local income investing content every week. Just a quick note, all financial figures in this video are extracted directly from MPACT's official SGX filings and announcements. This video is for education and awareness only, not financial advice. Please do your own due diligence before making any investment decisions. Chapter 1. What exactly is a REIT? A REIT, or Real Estate Investment Trust, is basically a way for ordinary investors like you and me to co-own large properties together. Instead of buying an entire building, you buy units of a REIT and you receive a share of its rental income as dividends. Singapore REITs must distribute at least 90% of their taxable income to remain tax-free at the REIT level, which is why many dividend investors love them. It's like having tenants pay you rent without having to deal with leaking pipes or angry tenants. Chapter 2. What is MPACT and what does it own? Meet Mapletree Pan-Asia Commercial Trust, or simply MPACT, one of Singapore's biggest commercial REITs. It's backed by Mapletree Investments, a Temasek-linked sponsor known for its solid track record and disciplined capital management. MPACT's portfolio is truly regional. It owns 15 commercial properties spread across 5 major Asian markets: Singapore, Hong Kong, China, Japan, and South Korea, giving investors a diversified exposure to some of Asia's busiest business and retail hubs. In total, the trust manages about 15.7 billion Singapore dollars in assets, making it one of the heavyweights in Singapore's REIT universe. Here at home, its flagship assets are well known to many Singaporeans. VivoCity, the island's largest mall and a retail powerhouse. Mapletree Business City, a top-tier business park that houses many multinational tenants. M-Tower, and Bank of America Harbourfront. Beyond Singapore's shores, MPACT's overseas crown jewels include Festival Walk in Hong Kong, a landmark mall and office complex, Gateway Plaza in Beijing, Sandhill Plaza in Shanghai, and the Pinnacle Gangnam in Seoul. These give the trust valuable exposure to prime locations across North Asia. As at 30th of September 2025, the trust reported the following key operating metrics. Portfolio occupancy at 88.9%, reflecting healthy tenant demand. Weighted average lease expiry of 2.2 years, meaning about 1/3 of leases renew each year, keeping income relatively fresh. And rental reversion, a modest minus 0.1% overall. Positive in Singapore, where rents are rising, but still negative in China and Hong Kong as those economies work through recovery. In short, MPACT's Singapore properties are the strong copy base that give the REIT its steady aroma, while the overseas assets are the milk froth. They add flavor, diversification, and growth potential, though sometimes they can spill over a little when markets get shaky. Chapter 3. Latest 2Q and 1H. FY25-26 results. Now, let's look at the fresh brew. MPACT's latest financials, released on 22nd October 2025, for the period ended 30th September 2025. For the quarter, revenue came in at 218.5 million Singapore dollars, down 3.2% year-on-year, while net property income eased 2.2% to $163.9 million. Yet despite the softer top line, distributable income rose 2% to $107.3 million, lifting DPU to 2.01 cents, up 1.5%. How did they pull that off? Simple: tighter cost control, cheaper financing, and steady cash flow from Singapore's crown jewel VivoCity. Zooming out to the first half of the financial year, gross revenue totaled $437.1 million, down 5.4%, and net property income came in at $329.9 million, down 5%. Distributions to unit holders stood at 4.02 cents per unit, down 1.2%. So yes, overall numbers were a little lower than last year, but the rebound in the second quarter shows signs of stabilization. MPACT's management seems to have kept the brew warm, trimming costs, preserving income, and keeping that dividend cup nicely filled for investors. Chapter 4. MPACT Valuation. Deep Dive: Market Price versus True Worth. At a closing price of $1.46 on 7th of November 2025, MPACT sits comfortably in value territory. Its market cap stands around 7.7 billion Singapore dollars, based on roughly 5.3 billion units in issue. With a net asset value per unit of about $1.79, it trades at just 0.81 times book, meaning investors are effectively buying its assets at a near 20% discount. Its price-to-earnings ratio of roughly 11 times is fair for a large-cap REIT, while return on equity sits around 7%, steady and sustainable. And with gearing at 37.6%, MPACT remains well below the MAS 50% ceiling, giving it room for flexibility. In short, valuation-wise, MPACT looks slightly undervalued, an appealing mix for income investors who want both a dependable yield and potential re-rating upside when market sentiment improves. Chapter 5. Dividend Yield and Sustainability. Now let's crunch the Kopi beans and see what MPACT's yield really looks like. Over the past year, the REIT paid a total DPU of 7.97 cents. At a unit price of $1.46, that works out to about 5.45% trailing yield. Looking ahead, analysts expect roughly 8.0 cents of distribution in the coming year. Again, about 5.5% forward yield. So, whether you look back or forward, MPACT's yield sits nicely at around 5.5%. Steady, not flashy, but satisfying for income investors. Now, about that payout ratio. Many websites show a 60 to 70% payout, but that's based on accounting profit. Under Singapore REIT law, trusts must distribute at least 90% of their taxable income, and MPACT actually pays out around 99% of its distributable income, fully compliant and transparent. As for sustainability, the ingredients look solid. A strong Singapore cash flow base, led by VivoCity and MBC. Manageable gearing with declining interest costs. But, some drag from overseas markets and a relatively short WALE of 2.2 years. All things considered, MPACT's dividend stream looks reasonably sustainable, as long as overseas occupancy remains stable and interest rates keep trending lower. Chapter 6. Future Prospects, Risks, and Fed Rate Cuts. Let's fast forward a little and see where MPACT could be heading. On the bright side, Singapore remains MPACT's anchor of strength. VivoCity continues to shine with strong tenant sales and full occupancy, while the Asset Enhancement Initiative there added 14,000 square feet of new retail space, boosting long-term returns. The REIT's cost of debt has eased to 3.23%, down from 3.56%, and with 78% of its loans fixed or hedged, plus a well-spread maturity profile, financing risks are under control. But there are still challenges ahead. China and Hong Kong remain soft, with negative rental reversions. A WALE of just 2.2 years means MPACT needs to stay proactive in renewing leases. And because part of its income is earned in HKD, RMB, and JPY, a stronger Singapore dollar could trim its translated income. Now here's where the macro story gets interesting. If the U.S. Federal Reserve cuts rates in 2026, it could be a welcome tailwind for REITs like MPACT, lowering borrowing costs, lifting distributable income, and potentially raising property valuations as cap rates compress. But if those rate cuts come amid a global slowdown, weaker tenant demand could offset some of those gains. So the sweet spot for income investors? A world of gradual rate cuts and steady economic growth. That's when MPACT's blend of stable income and capital upside could really shine. Chapter 7. How Singapore income investors can evaluate MPACT. So, how should Singapore income investors size up MPACT before taking that first sip? Think of this as your COPI checklist. First, can you stomach overseas risk? Singapore gives you stability, but exposure to China, Japan, and Hong Kong means more volatility when global winds shift. Second, is a 5.5% yield enough for your risk appetite? It's attractive for income seekers, but remember, REIT yields aren't guaranteed. Prices and distributions can fluctuate. Third, keep an eye on gearing and refinancing. At around 37.6%, MPACT still has room to maneuver before hitting regulatory limits, and lower interest rates could help reduce financing costs further. Fourth, balance value versus quality. Trading at roughly 0.8 times book value and 11 times earnings, MPACT looks slightly undervalued, especially if you believe Fed cuts will push REIT valuations higher. Finally, think long-term, 3 to 5 years. You're betting that Singapore's assets remain strong, overseas markets stabilize, and interest rates gradually ease, a combination that could lift both income and price. Final thoughts. To wrap it all up, MPACT is a pan-Asian REIT anchored by some of Singapore's strongest retail and business assets. Its second quarter and half-year FY 2025-26 results show steady income, disciplined cost control, and early signs of recovery. At $1.46, MPACT offers a 5.5% yield, trades at about 0.8 times book, and carries moderate gearing, making it a slightly undervalued pick for Singapore income investors who want consistent dividends and long-term value. If this breakdown helped you understand MPACT better, smash the like button so more Singaporeans can learn about REIT investing, and subscribe to Wealth for You for more smart, local dividend insights every week. And tell me below, would you buy MPACT for its 5.5% yield, or do you prefer pure Singapore REITs like FCT or CICT? Stay cash flow rich, not paper rich, and I'll see you in the next video.